Let's get to the top picks. He's kicking to the sidelines, as they say in rugby, for this first one. Cash.
Yeah. So we still think so. There's a few patterns. First of all, we do think that the S&P was, because it had such concentration in the Magnificent Seven, as they like to call them, and just the market got overdone. We thought that it would pull back, and there's seasonal factors that come into around the end of September from here, just after Labor Day. Actually, up until Labor Day, it can be usually good, and then after then, not so good. So we're holding some cash. We're about 21% cash, and we hold no tech, and we hold commodities and value stocks. So because we have about 20% cash, we decided we should put cash as one of our top picks. But that could change in 2 or 3 weeks. So just caveat emptor that I'm not holding cash for the next 12 months. I'm holding it for the next few weeks.
But it's time to be cautious, relatively speaking, about the markets.
Yeah, I think the S&P, for example, could pull back to maybe 42, 4,300.
42, 4,300. How painful would that be?
Not much, a couple hundred points. 300 points.
Yeah. So we have an S&P today of about 4,500.
Yeah. So 200 to 300 points.
Okay. Hudbay Minerals, a copper name.
Yeah, so fits into that whole commodity thing that we like. And this is, my gosh, I keep showing sideways charts. So, but we are trading this. We do think that it's amongst the, I mean, if you look at oil, it's all at the top of the range, right? We talked about that earlier in the show. So if people are looking for a commodity to enter into, I think that anything kind of copper and mining orientated is not a bad place to be, because some of them are near the bottom, and Hudbay is no exception. We own this. We were buying it all through around this range, and we think it'll get up there. So that's the trade. Maybe
we could put up a 5-year chart for copper, because copper, there has been a bit of pessimism about base metals with this economic weakness in China. I mean, I think there's a school of thought they've overbuilt infrastructure.
Yeah.
And that's a big source of demand for copper. What does that chart say to you?
Well, we'll talk about China in a minute, because we look at it as a contrarian view. China's going to stimulate, and that could help copper. But having said that, just looking at the chart, again, that's what you call higher lows. Now this is a lower high, so that's a bit of a triangle. If it breaks out, then you're looking at, pushing 5.
Which would be very bullish.
Which would be very bullish.
Copper stocks.
So if it breaks down, then you get out. But that's doesn't seem to be doing that. So we think the picture and the argument for the longer-term commodity trade is good. So we're stepping into minerals a step at a time, and as I said, Hudbay is one of them.
The US dollar is actually near a 5-month high today. So that's a headwind for commodity prices. So it's impressive that copper is holding up. Yeah,
and what happens if it weakens, right?
Yeah.
So I'm not making any predictions on the US dollar, but you tell me, is it an ideal place to buy? Or, maybe not. But it's right now, I would give an argument that if the US dollar even continues trading sideways, there's an argument for commodities to be okay.
Okay. And then, as advertised, your last idea is a Chinese ETF, BMO MSCI China ESG Leaders ETF.
Yeah, they just changed that. It never used to be called the ESG. So everything's got to be ESG now. So we just like these are the bigger companies that you've seen, Baba and all them. We think we bought this cheap, so far so good. So we bought it near the bottom because it's in a range, and it seems to be the theme today. But we're not looking at a long-term trade, but we thought it was so oversold, near the bottom of a trading range. We just thought this was almost like too easy, because there was so much bearishness on China. If you look at the sentiment traders' optics, like everybody hated the trade. And if you looked at a Google Trends, I've written a book on sentiment trading. And if you look at the Google Trend search tool, it's, China, type in China economy, and like the searches were off the roof. Whenever you see too many people, we call it a crowded trade. So too many people think one way, then it gets to an extreme point and we go in. Because that sentiment will reverse. Like, too many people will be wrong when they're all in the trade at the same time, okay? So we're just trading a bounce. We think it was oversold.
I mean, it's interesting on ESG. The smartest definition I've heard is that it's really a measure of how likely companies are to encounter liability, to be sued over bad governance, bad environmental. It's not about doing good. It's about dodging lawsuits.
Yeah, that might be a good explanation for it.
Yeah.
I mean, I don't pay a lot, truthfully, I'm a chart guy, so to me it's just what's the stock doing, right? Ralph Acampora 101. But, hey, whatever. If they want to change the name, go ahead. I'm just trading the stock.
And this one, it avoids tobacco, alcohol, gambling, firearms, and any controversial weapons. Yeah.
Okay.
Anyway, thank you very much, Keith.
Good to be here.
Keith Richards, the one and only. Let's get to the top picks. Allstate, the giant insurer.
Sure, and all property casualty insurance companies are going through a really rough ride. If you look at the hurricanes, catastrophic losses, cost of repairing cars and houses are way higher than anticipated, so most of them are suffering this year. That being said, in the P&C business, bad news is good news, because guess what? They raise their prices next year. They never seem to cut them. Allstate has done such a great capital allocation job, Andy. 10 years ago, there were 450 million shares outstanding. Today, there's about 260 million shares outstanding. They keep on raising their dividend, and they are a smart company because they want profitable business versus market share. So they're getting out of areas where they can't make money, and a spectacularly run company.
And so they bought back about half their stock, or
They
not?
bought back more than half their stock. The last
half.
20 years, they bought back actually more than half their shares. They bought back, and they're a free cash flow machine because they're so focused on profits versus gaining market share.
Your next idea, US player, CVS Health. I know some people have misgivings because they're in so many areas now.
They are. CVS is probably the best, widest run healthcare business in the US. They're in pharmacy benefit management. Of course, they're in stores. They're in areas that help companies save money on healthcare costs, various different consulting businesses. They've made a bunch of acquisitions. They are still a free cash flow generator. Their debt is more than manageable. They've been reducing debt. You're getting a 3% dividend yield and a stock at 8 times earnings. One of the reasons it's down is because there's foot traffic is down because a bunch of people were going in last couple of years because of COVID. Less foot traffic, less consumer spending, a temporary lull because of economic slowdown. That being said, 8 times earnings, 3% dividend yield. This is when you buy these great businesses.
The stock came under pressure in August because Blue Shield of California dropped their pharmacy benefit management.
Correct. Dropped
operation.
a small part of the business. They kept some of the most important parts of that business. Listen, it's a competitive world. Everybody's focused on cost. The key for them is, are they gaining more business than they're losing? So we expect that they will continue to gain more than they're losing, but there's competitive pressures. They are responding. Costs are coming down in some of those areas, but they are the behemoth, and they are the best position in that area.
Yeah, it's interesting. These pharmacy benefit managers, I was always skeptical that they saved the health system money, and now people are looking at the fees they
Sure. So they actually, one of their big businesses is saving money for businesses. So General Motors would hire the PBM and be able to measure the cost savings.
Yeah. But apparently the PBMs have been extracting fees.
They
for
certainly
listing
take
drugs.
their pound of flesh, as they say. And also, it's impacting the users of some of those things because some drugs are disallowed, more co-pays. And it's a difficult area as everyone is trying to rein in healthcare spending.
And of course, America is finally going to start negotiating with the drug industry for Medicare costs after
on
years.
At least some of it.
Oh my goodness, yeah. So they're going to price negotiations for the first 10 drugs. Why have they not done that? Anyway, the drug lobby is...
Lobbying.
Yeah, so powerful. ING Group, finally, European financial giant.
Sure, and really a pure retail bank in the Netherlands, Germany, and Belgium. They were a mess after the financial crisis. They had to eliminate their dividend at the time. They are now very overcapitalized, extremely well run, boring, profitable, 5.5% dividend. They'll be using excess cash to buy back a whole whack of shares and powering along. And for us, this is just probably the best run European bank.
Yeah. Critics of the pharma industry, sorry, just to go back to that, when in 2003, America put drugs into Medicare, prescription drugs, but President George W. Bush, the law he signed, explicitly banned the government from negotiating prices. Yeah?
The U.S. is the only government in the world that doesn't have negotiation with drug companies on drug prices, yet it costs them a ton of money.
Yeah, but they pay, I think it's about twice as much in America to buy drugs. Yeah.
You have some Americans coming to Canada to buy their drugs.
Yeah, and of course, the poorer or lower income people, I mean, who aren't in a drug plan or don't have a proper drug plan. Yeah, anyway, it's the Americans. It's the Americans. They do things their own way. Yeah. Lauren, thank you very much indeed.
Andy, thank you so much for having me.
First topic is Origin royalties. I think part of their business is staking or acquiring exploration targets and then selling them off in some cases for royalty interests.
Yeah, they started life as a prospect generator, my favorite form of exploration finance. They've been successful twice. They made a discovery, which is now the Ermitaño mine, silver mine, in Mexico, which is operated by First Majestic Silver. In addition, they were part of the discovery of Anglo's silica cap deposit in Nevada. A deposit which threatens to be a tier 1 deposit, and I think will generate substantially more royalty income for Origin. My suspicion is that the silica cap royalty by itself is probably worth the market cap of Origin. This is certainly a case where the sum of the parts, the value of the sum of the parts, is greater than the price of the whole, which is attractive to me. It's very closely held. So I need to say to BNN Bloomberg viewers, if you're going to buy this, exercise caution. Use good till cancel limit orders. In addition to the fact that the market capitalization is fairly small, the stock is very, very, very closely held. So it will be extremely volatile. Don't rush into this one and jam the price.
Your next idea, EMX royalty, about half of its asset base in Canada and the US, but then in Norway, Sweden, Chile, a little bit in Serbia.
Wonderful prospect generator, been around for a very long time. Like the last company, I own a fair bit of this company personally. The reason that I added it today was because they very, very, very recently, 3 or 4 days ago, reached a settlement with China's Zijin mining company around a very important royalty that they have in Serbia. My suspicion is that this royalty alone is worth the market cap of EMX royalty, but EMX royalty enjoys substantial free cash flow from royalties both in Nevada and in Chile. This is a company, unlike many other royalty companies, that in addition to buying royalties, in fact, creates their own as a consequence of their own exploration activities. I've known the people for a very long time. I hold them in very high regard.
And then finally, G Mining Ventures with the Gignac family involved. Why? Give us some background here.
Well, I've done business with and benefited from the activities of the Gignac family for a very long time. I watched with particular favor their ability to build on time and on budget the Fruta del Norte gold deposit for Lundin Gold, a real challenge in Ecuador. But as I say, I've known them for a very long time. They're specialists at building mines in tropical environments on time, on budget. A wonderful example of the export of Canadian extractive technologies around the world, by the way. G mining comes from the fact that they want to begin to do this for themselves, not just for other people. The consequence of that is they bought a deposit from El Dorado mining in Brazil that we'd had our eyes on for a very long time. They are proceeding to build the thing. It is in what, in Lassonde curve parlance, you would call the boring phase right now, which is to say the construction phase. There's not very much news that excites investors. The construction phase, if it's followed by successful implementation, usually results in a re-rating of the stock higher after on time, on budget completion, once nameplate capacity is has occurred. And the Gignac family has a long track record, in fact, of on time, on budget, nameplate capacity completions. And so I own this precisely because I think that following the boring period, which I suspect will be 9 or 10 more months in duration, that we'll see a re-rate on the stock as a consequence of successful completion. The risk, of course, is that in the implementation phase, that they won't be on time, on budget, and or generate nameplate completion.
So the Gignacs are involved in building mines for others, but also developing their own properties.
Correct. They have a history of building them for others, although they were involved as shareholders in some of the companies in the past that they had built mines for. But they're primarily known as a third-party contractor building mines, and in particular mines in tropical high rainfall environments where they are considered probably to be the best of breed, best in the world.
That's interesting. Yeah, they built the Marianne mine in Suriname, and they also also the Essakane mine in Burkina Faso for IM Gold. Rick, always informative, always fun. I wish we could have you on the show every day. Thank you very much for joining us.
I'm available, Andrew. Thank you very much.
Thank you. Rick Rule, the one and only, joining us there. First idea is a bond issued by Synovus. The maturity date, March 10th, 2027.
So let's go right. So Avenue, we do, it's private client, and we, look after, wealth planning. And so the big picture, what we're trying to explain here is that for 10 years of no interest rates, you used to just have money in the bank, money in GICs, T-bills, that kind of thing. And we've lost our muscle memory that there was just a certain amount of just cash are just sort of kept, at the short end of the risk curve even. And so right now, because of a one-year T-bills at 5%, the idea is why don't I just park my money all in one-year T-bills? Our argument right now is that, there's a certain amount of money you do want at the short end or have available, but on a reinvestment risk, if we really are in recession, we're still gaming that there's something. Interest rates have been pushed so high, something's happening at some point. And 1 year from now, if interest rates, the yield curve still has to adjust. You're never going to lend money long if you don't get a higher rate of return for it. So at some point, short-term rates come down or long yields go higher. And if this time next year, short-term interest rates are 3%, I wouldn't be surprised. So go in and I'm looking for a 3-year bond, and this is what we've done is saying we're right now Synovus, and we picked one that we think anybody can phone a broker. There's lots of them around. Okay. It should be an easy one to buy in a corporate bond. Go to corporate bonds. This is actually a 3.5-year bond, and you get 6%. So and then
yield to maturity.
Yield to maturity.
Yeah.
So instead of just doing 1 year at 5% in a T-bill where we really think there's strong reinvestment risk, that's great. But we want to get the extra yield from the corporate bond, and we want to go out a little bit further. And just sort of pick Synovus because, again, this is a commodity cyclical, but a couple of things we talked about earlier today is we think the commodity cyclical part is actually in great shape in something like Synovus, even for 3.5 years.
From our chart there, it looked like it's trading at a slight discount to face value.
Right. So if interest rates still move, like you might on a net basis, on a mark-to-market basis, you might lose money, but you're not losing. It is going to mature, and you're going to get 6% over 3.5 years.
Yeah, so you don't really...
Compounding.
Yeah, market moves are kind of irrelevant.
And it's very specifically doing that instead of the 1-year T-bill investment.
Archer Daniels Midland, a huge player in the food industry.
So again, going through everything we look at, there's so many of the stocks are just in the middle of a range. And so this, just picking on, we've talked about our infrastructure theme, our real estate theme, and the CapEx theme. This one, though, is agriculture, which is a highly cyclical business. We actually think over the next 5-10 years, there is going to be a strong agricultural cycle going through all the different businesses. We think this has the best rate of return on capital, consistency. Nutrien right now, great company, but it gets slightly less rate of return. It's more capital intensive, and right now you're seeing it. You're going through there's too much fertilizer out there. So we think you actually eliminate a lot of that by going to an Archer Daniels, and we can be in the food space for the next 5 years, and we'll be able to make money in the stock. And it's not at a high, it's sort of pulled off here. Still could go a little lower. I mean, there might be a cleanup if we have this, interest rate move, but we really like it.
Okay, and then finally, Timber Creek Financial, a player in mortgages?
Yeah, so a MIC, Mortgage Income Corporation. And so I've over 20 years beyond here, I've spoken about Timber Creek occasionally. It's got such a unique business plan, which is it's almost like the high yield mortgage department of a bank, except it's stripped out and they just do it themselves. So it's a pool of money. The money doesn't change. And I would said over being an investor for 15 years in it, just like what's the worst thing that could happen? Well, the loan defaults and you become a landlord.
Okay.
So right now we're in that though. So where this interest rate move is showing up first is in the real estate market. It's commercial real estate market, and so I don't want to talk about it today. We still own it. I'm not backing the truck up on it at this level. We want to see it work its way through. We want to see the way that other things are trading if we add to the position. But we do own it. You're getting a high yield out of it, and this is just talking about it. It has a way of working its way through the loans. So right now, if you're in receivership from one of their loans, you take possession of it, you sell it on the market, and so this is their bad day. But in speaking closely with the company, it's hard to predict exactly what's going to happen. But you're buying it at such a discount to its cash value that can cover off an awful lot of issues, and because they're all short-term loans, it recycles itself very quickly. Doesn't mean the next 3 months or 6 months aren't going to be painful, but we're talking about a business when it's in the middle of the painful part and it's trading at a discount already. And I hit one point on this, like what tends to happen when you have a bond market, take 2008 credit market crisis, was that about 8% of bonds in the US went bankrupt, but the market priced in 25% of bonds were going to go bankrupt. So it's always the market explodes and was way too negative too fast, and then that's where the Howard Marks bond guy, that's where he says that's where the advantage is. And in parts of the stock market were already there, we feel. And so just talking about Timber Creek on a bad day and saying we're there and we're accumulating but you still have to take that income and you got to keep picking away, like buying things with the income while we're going through here.
I'm showing a yield of 10% on Timber Creek.
And they have 2 listed bonds as well. So you could actually get about 9% on a 5-year Timber Creek bond, so even safer. And the loan to value is about 70%. And the loans turn over very quickly. And they also have a whole team of people if you repossess the property and then you sell it back into the market. And last I looked, the property market outside of downtown office, it's not terrible.
Yes, and it pays a regular dividend of 5 3/4 cents every month. It looks like Timber Creek, or has been lately.
What it does, it can't accumulate income. Whatever it makes, it has to distribute.
Oh, I see. Yeah.
Right.
Well, we better leave it there. Always food for thought. Thanks very much.
Yeah. Thanks for having me on.